Hey, welcome back to Catalyst. I'm joined now by Yahoo Finance's Inez Ferre. Inez, thanks so much for joining us on the desk here. Let's dive in to the currency market for this next conversation. The U.S. dollar is edging slightly lower after the U.S. added more jobs than expected in June. For more on this, we have Jane Foley, who's the head of FX strategy at Rabobank. Great to have you here with us this morning. First and foremost, I want to get your reaction to what we saw come through in that piece of economic data and why we might be seeing this type of reaction, what the typical kind of nature of and correlation to the dollar and the employment report is.
Well, first of all, thank you for having me. But this wasn't necessarily all about that headline number. It was about what else came within that report, and particularly the revisions. So we saw a significant downward revision to the last 2 months worth of payrolls data, meaning that a month ago, when we were here, staring at what we thought was a very, very strong payrolls report that month, well, actually, it wasn't as strong as we thought. And so in addition to that downward revision, we also got a tick up in the unemployment rate. And I think put that all together, and you can say, yes, you know what, we got a report which perhaps went into the same sort of way as the economic data that we had earlier the week was suggesting, which is a cooling in the US labor market. Certainly not one that is falling out of bed, but certainly one that is cooling. And that only served to just reinforce some of that excitement that had built during the course of this week that, yes, you know what, a Fed interest rate cut in September and then maybe even later in the year as well is certainly, a primary risk.
Certainly. And how many cuts are you pricing in from your own purview?
Well, here at Rabobank, it's two, which I presume isn't too far away from a market consensus. So a September interest rate cut and probably another one in December. But that said, all economists, in addition to, the Fed policymakers, are still going to be looking at forthcoming economic data to get further justification for those sorts of forecasts. I think so far, the data that we had this week, the ISM numbers, that the labor data that we had today, that the labor sub-index of the ISM data all point to the prospects that, yes, that the economy is slowing down sufficiently to bring that interest rate cut. But again, you look at that prices paid subsector of the ISM, it's still quite sticky. So, there are still elements here with respect to inflation and particularly services sector inflation that policymakers are still going to be a little bit concerned about.